Welcome to Chapter 11, Capital Budgeting and Decisions. Now, you might hear the word budgeting and you think, well, we got to sort of make a list of what we spend and what we're going to earn, and that isn't really what capital budgeting is about. Capital budgeting makes reference to our assets that are long-term in nature, our equipment, things like that, as opposed to our operating budget. Now, take this copier scanner thing here I have behind me. While not the most expensive one on the market, it would still not be cheap if it suddenly died tomorrow and I had to replace it. And part of the capital budgeting process that I have is to develop what's called a sinking fund. And what goes into that fund is money toward the replacement of fairly pricey assets that might not be in the typical operating cash flow budget. And, they're going to have a pretty predictable lifespan. And I want to make sure that as I'm nearing the end of that lifespan, that I've got funds that have been earmarked for the replacement of those items. So that's kind of one way we look at capital budgeting. Another way that we look at capital budgeting is when we're making an investment in something that perhaps we've never owned before. And we want to consider whether we should be buying a piece of machinery or something like that, or deciding which piece of machinery we want to buy. Do we buy the lower end item, which might need to be replaced sooner, that might require greater maintenance, or do we spend the money and buy the top of the line Mercedes-Benz equipment, which might cost us more money, but it may last us longer in the end. On the other hand, if we're not completely convinced that this is going to be a profitable venture for us, do we want to sink a whole bunch of money into it before we really know where we are going with that? So when we are evaluating the decision making that we're going to make, there is basically a 5-step process, but where we're going to begin our analysis was kind of sort of at about step 3, but we'll talk about the early steps just so you kind of know how we get to step 3. But first we have to do an assessment of what our future needs and existing needs are and figure out what kind of resource limitations do we have. Are we limited based on space? Are we limited based on money? Are we limited based on time? Maybe we would like to get something that's coming out, but maybe we need to make the decision before the item is going to be available in the marketplace. So who knows what kinds of resources that resource limitations we might experience. Then we need to have a baseline criteria for the alternatives. And then we will evaluate these alternatives and kind of whittle down our options. And then at that point, we will hopefully pull the trigger and make our decision. There are a couple of considerations in this decision-making process. And those are the considerations that don't take into account the time value of money and those that do. Now, what do I mean when I say the time value of money? And I'm going to just pause here and just play a short little clip. Now, this is a clip from a really old cartoon and points to anybody who can figure out what this cartoon is. But when I think of time value of money, this character and this phrase that he says is something that I always comes to mind.
I'll have a hamburger, for which I will gladly pay you Tuesday.
Okay, so he wants a hamburger today, for which he will gladly pay on Tuesday. character's name is Wimpy, by the way. And what Wimpy is trying to get us to believe is that if he pays us that $2 on Tuesday, that it's really the same as if he paid us today for the hamburger. And that's not true, because if he pays us today for the hamburger, we might be able to invest that money and grow that money between now and Tuesday, such that by Tuesday, if that money theoretically might have been worth more to us. And so if by waiting until Tuesday, we effectively lose the value that we could have gained by investing that money between now and Tuesday. Now, that's sort of an extreme example, and yeah, you're probably not going to get a lot on that, but maybe you do. Maybe you buy a scratch ticket with your $2, and you know, maybe you strike it rich or something, or I don't know, maybe not a scratch ticket, but maybe, I don't know, maybe you buy a lottery ticket. But anyway, you get the idea. If you have the money today, there may be decisions and things you can do with that money. Maybe you use it to pay down some of your debt, so that's that much less interest that you are paying on something. And so you might incur additional interest by waiting until Tuesday to take that $2 to pay off your debt. So one of the decision-making factors in a capital budgeting decision is something called payback period. In other words, how long is it going to take to recover the money from this investment? And so the calculation for payback period is our initial investment divided by the net annual cash flow. So what's the net annual cash flow? That is cash inflows minus cash outflows. What would be the example of some cash inflows? Well, maybe we have new sales or new revenue as a result of having made this investment. Maybe we're going to retire an old piece of equipment. We can sell that old piece of equipment and get some money for it and consider that toward the payback of making the investment in the new piece of equipment. So those would be the kinds of inflows. What about the outflows? What's going to go out for us in this? Well, the cost of whatever it is, but there may be installation, there could be shipping, maybe we have to hire some or train our people, and that might cost us money. So, any of the factors that are going to go into getting this investment kind of up to speed, and maintaining it along the way. Maybe it requires more ongoing maintenance, who knows? But we've got to calculate all of that in when we are determining our payback period. So let's look at an example. We've got a printing company considering a printer with an initial investment cost of $150,000. They expect an annual net cash flow of $20,000. The company expects a payback period of 6 years on these types of investments. So the payback period for the printer is actually 7.5 years. And if the company expects that for this kind of money, they want to have their payback happen in 6 years, this is not a good decision for this company, because at 7.5 years, it is a year and a half more than kind of their threshold that they have established for an appropriate payback period on those kinds of decisions. Now, calculating this payback period becomes a little bit more challenging when the cash flows are going to be uneven. So when that's the case, we may have to break down and so this is an example of how we're going to look at it, where we've got these uneven cash flows, and then we're going to have this kind of, for lack of a better term, wonky kind of final year. So we've got an initial investment of $40,000 and net cash flows of $10,000 in years 1 and 2, $5,000 in years 3 and 4, and $7,500 for year 5 and beyond. So we've got the initial outflow of $40,000 at the outset. We've got 10,000 in years 1 and 2, 5,000 in 3 and 4, and by the end of year 5, we're kind of close to breaking even, to having recouped our investment, but we got to dip a little bit into year 6 in order to do that. And so basically we more than recover by about 5,000 the cash flows. So in order to get that partial year figure, we're going to take the overage as a result of having gone over into year 6, the overage of the 5,000 over the year 6 cash flow figure to come up with the partial year calculation of 0.33 of a year. And so based on this example, and I'm trying to kind of hide myself here, I guess, the payback period becomes 5.33 years. And so, and whether or not the company decides that they're going to accept this, if this is the same company that we had before, that they would need a 6-year payback period, then the 5.33 certainly fits that 6-year payback period requirement. And I'm going to actually stop this video here and go on to the next one.